All right, Anand, stay with us. I just wanted your view on PVR as well. We broke the story yesterday that the PVR-INOX merger has got the NCLT approval, not a written order, but it's been given the go-ahead. Let's just revisit that story with Nimish. Nimish, hi.
Hi, Prashant. So, post-evening yesterday, there was a confirmation from Inox management that, yes, they have got an oral order from the NCLT Mumbai that the merger between PVR and Inox has been officially approved. Now, the written order is expected in the next 15 to 20 days. Post that, the process of the new entity will start, and that could get over in the next couple of months. In fact, if you look at the ratio, it's basically 3 shares of PVR for 10 shares of Inox. Now, the merged entity will be a force to reckon with an pan-India presence of more than 1,600 screens. The merged entity aims to add 200 screens per year. In terms of board representation, both the companies will have 2 members on the board. The Inox promoters will own close to 17% stake in the company, or 16.66 to be precise, and the PVR promoters will own 10.5% stake in the merged entity. The merged entity, after it comes into force, will have a 40% market share in the top 7 cities. So, the final hurdle or the big trigger for the stock is now out of the way, and the NCLT Mumbai has finally approved the merger between Inox and PVR last evening.
All right, thanks very much, Nimish, for that. It's at an interesting juncture, the stock. I'll put out a chart a little later on Market Laser today on PVR, it had a bit of a breakdown and it's now coming back up. Yesterday, the stock finished about, 2.5% higher. Anand, what's your sense? The merger gets the go-ahead, but it's not as if there were grave doubts whether the merger will get a go-ahead or not, right? But of course, I mean, it's not done till it's done, and now it's closer to being done. Your sense?
Well, I don't see a problem with the merger per se. Both for the management of both the companies, it kind of makes sense to consolidate. As your analyst pointed out, it will make it a monolith, the dominant player in the sector, especially in multiplexes. There will still be a lot of single screen halls around, but at the end of the day, the highest value comes from the multiplexes. So from that point of view, with that kind of dominance, they'll be able to get better deals. But I think we have to realize that, and the market has shown us over the last few quarters, that what is important in the movie business is the movies. The content is king. It is not the place where you're showing that. And now with the OTT becoming a real threat in terms of an alternative, the kind of dominance and the kind of revenue growth that they were witnessing prior to the lockdown and COVID, I don't think you're likely to see that going forward. So I think, it's still, to my mind, not the best of places. What exactly are you playing for?
All right. Okay. We have the management of Sign, which will be with us in shortly, so we'll bring them in. Anand, just